Greetings and welcome to my second video, and the first where I actually outline a real trade. The greater portion of this video will outline the actual process I utilized in figuring out exactly what stock to buy. In my last video, I mentioned that I felt the rhetoric that day trading is extremely risky is actually a myth. On the contrary, I feel that day trading is actually much less risky than traditional buy and hold stock investing. That is, if it's done correctly. Now, I don't claim to be any expert. Obviously, I am just getting started here. But the only time that I tried actual investing or buying and holding of stocks, I started with $4,000 and ended up with only $2,200. Now, I'm not suggesting that that limited experience is in any way a good, it's certainly a small sample size, and it's not a good indication of anything really. But the reason that I do have a good reason for feeling that day trading is much less risky than traditional buy and hold. And it's all in the strategy. You see, when you're making a day trade, employing the strategy that I've developed, which is actually rather aggressive, and I'm sure is pretty similar to some strategies that are being used by successful day traders. I'm only exposing 2% of the value of my trade to loss at any one given time. Okay, I see the blank stare. Let me explain. Say, for example, I buy 2 shares of Apple at $100 per share. So I spent $200. In a perfect world, I would put in what is called a bracket order. Using the strategy I've developed, I would wish to sell the stock if it rose to $103 or if it fell to $98 per share. Using a bracket order, the site automatically executes your order for you when and if either target is reached. So if I buy Apple at $100 per share at 9:30 a.m. and if it rises to $103 per share by 9:40 a.m., my order executes and I sell my position at $103 per share. It's over and done with, right, just like that. However, unfortunately, Robinhood does not offer bracket orders. Therefore, you have to keep your eye on the stock a little in order to effectively pull off this strategy. If you didn't know it already, Robinhood is a phone app, so you don't have to be looking at your computer all the time. Once you've initiated your order, you can easily keep an eye on what's happening on your phone. It's really not that hard. What you can do on Robinhood is, you can't do a bracket order, but what you can do is you can do a limit order or a stop loss order. Now, a limit order is telling the broker to sell the stock when it reaches a certain target price. In the above example, $103 would be the limit price. This will have the effect of locking in your profits once the stock has reached a specific price. That way, you don't have to watch the price and be quick on the draw and sell it immediately. It's all done for you automatically. On the other hand, the same thing is done in reverse with a stop loss order. It's telling the broker to sell the stock when it falls to a certain price. In the above example, $98 would be the stop loss price. Note that the potential percentage gain is more than the potential percentage loss, 3% versus minus 2%. That is part of the strategy. This way you can have an equal number of wins and losses and still end up making money. Now, wouldn't it be nice we could set up both orders at the same time, and then if one is filled, just have the other one be canceled? Yes, and there's a name for it. That is the above mentioned bracket order. Now, the word on the street is that Robinhood plans on offering bracket orders in the future, but no time frame has been specified. In the meantime, you can do limit orders or stop loss orders. You simply cannot do both at the same time for the same stock, at least not yet. So now simply I will go, now finally I will go over the simple strategy I employed in deciding which stock to make my very first purchase in the first place. My limited research suggested that I should buy stocks that have a high volume, because in order for a stock trade to happen, there has to be somebody out there willing to take the other end of it. When you put it in, it's right there. Excuse me. From what I understand, when you put it in, there's no real guarantee that the trade is going to go through. I don't know all the ins and outs of it yet, and I'm sure I'll learn more on the topic in the future, but for the time being, let's just assume that high volume is important for a day trader. So what I did is I went to this handy dandy website called Bar Charts, and I found the volume leaders. Let me show you what I'm talking about here. Okay, here's the website Bar Charts, and I go to Market Pulse, and under Market Pulse there is a column that says volume leaders, or a chart that's called, a page that's called volume leaders, which I assume goes over the volume leaders. There's the volume leaders, Bank of America, etc., and 231 million some odd shares. Okay, but now what I do here is I look only for the stocks that went down in value. This is actually being done on the day that the stock market went down 600 points, so you're going to see a lot of red here. Anyway, basically I want to look for a stock that has gone down at least 3%. Here, this one is the biggest loss on the volume leaders of 27%, and you can see there's a whole ass ton of stocks that went down a whole lot today. This isn't going to be typical. On some days I haven't even seen a full page here of stocks that went down more than 3%. But anyway, let's just, and beyond that, then let's see, beyond that I want a stock to cost at least $5. You see here, this is the last price of the stocks in question, $5.43, $3.33, etc. So using my own rule, I would not buy this stock because it's below $5. I also prefer that a stock is below $20, just so I get a lot of exposure, because that way I can buy more shares. So a lot of these stocks would qualify. And so let's look at the first one, for example. It went down a whopping 27%. But I have a funny feeling, yep, here it is. It is being evaluated as a strong sell by Bar Charts. I just decided, why should I buy a stock that is being recommended to not buy? So I'll pass on that stock and look at another one. And pull up Market Pulse. And, well, I could probably have done this faster. Volume leaders, percent, negatives. Okay, we'll skip that one because it's below $5. Let's look at Barclays here. It's a sell. You see that? Now, I'm gonna look for one that's marked as a buy, just so I can show you that it doesn't say to sell everything. I'm just okay, here for example. See, the site recommends this as a strong buy. So if I was to look up, so I start by looking up a volume leader and making sure that it went down at least 3%. I look for a strong buy. I look at the charts. Basically, I use my own judgment to try to figure out if the stock's going to go back up. And that's basically what I used in the first trade. I looked for a volume leader, I looked for a stock that went down at least 3%, and I looked for a stock that was evaluated as a strong buy by Bar Charts, this website. So then beyond that, let me tell you what actually happened. My first foray into the wild world of buying stocks ended poorly, unfortunately. To make an already too long story shorter, my first choice, based on my research, was INO. Don't know what it stands for, don't care, it's a pharmaceutical company, I remember that, but I really don't care. As a day trader, I just look at numbers. At 9:53 a.m. on June 22nd, I bought 17 shares at $10.70. By the way, that is the most I could buy. Robinhood only allows you to spend 95% of your available funds, so I had $190 to spend. And by the way, unless I tell you otherwise, you can always assume I will always spend as much on a trade as I can. So it should be obvious the cheaper a stock is, the more shares I can buy, and vice versa. Note, the total amount that I spend will not change. It will always be 95% of what I have in my account. Remember, however, that only 2% of that investment is at risk at any one time, or at least that's the intention. So there's never a great exposure to risk. Also note that the cheaper a stock is per share, that just means that I will buy more shares. So for example, if I had $190 and the stock I was buying was $19 a share, I'd buy 10 shares. Whereas if I had $190 and the stocks were $10 a share, then I'd buy 19 shares. I'd still be investing the same $190, just the number of shares just varies based on what the price per share is. I was still learning, so I could not put in the stop loss order until after I had bought the stock in the first place. Excuse me, I mean, I knew I couldn't put in a stop loss order until I had made the purchase in the first place. But I hadn't figured it out yet, so I had to figure it out on the fly after I had already made the purchase. While I was trying to figure it out, unfortunately the stock was falling, and fast. By the time I finally figured out how to put in the stop order, the stock had fallen to $10.50, only 4 cents above my stop loss of $10.46. And unfortunately, the stock was falling so fast that it had fallen all the way down to $10.36. Excuse me, it had fallen all the way down to $10.36 before I managed to swipe my phone and get the order executed. So I lost a whopping $5.78 on my first trade, which was about $2 more risk than I was supposed to be exposed to. Frankly, however, I think most people would agree that $2 is a small price to pay to learn such a valuable lesson. Anyway, that'll do it for now. I'll see you in my next video, and it's a good thing this one's coming to an end because I'm almost at my time limit. See you soon.